To Lampkin and Associates, CPAs. So today's video is going to be about the accounting process and what you should expect from your CPA firm or your accountant. So we're just going to go over the month-end close process according to GAAP. So this is accrual-based accounting, and this is what you should accept, nothing less than this. So again, my name is DeMarco Lampkin. I am the Chief Executive Officer here at Lampkin and Associates. So we're going to get started. Here's today's agenda. I'm going to introduce myself. I'm going to go over cash-based accounting versus accrual accounting. And then I'm going to kind of explain what GAAP principles is in accounting. And then I'll talk about the month-end close process and what you should expect from your accountant. And then I'll go over any questions that you may have. So my name is DeMarco Lampkin. I have 22 years of experience in accounting and finance. I've worked at all types of large companies, anywhere from California Pizza Kitchen to J.D. Powers and Associates to Live Nation to Universal Music Group to Warner Home Video. And I had high-level accounting positions here, anywhere between senior accountant, senior financial analyst, to assistant controller, to accounting manager, to controller. All right. I also have a bachelor's of science degree in business management from Cal State University, Northridge. I have my master's in business administration from Woodbury University, which is a private school, in not Beverly Hills, but in Burbank, California, in the hills of Burbank, California, that is. And I had emphasis in accounting and finance. I'm also a member of Beta Gamma Sigma. So, and some of the things I do, just a little side note, I teach day trading classes and stock option classes. I've been doing that for about 6 years now. I've been swing trading also since about 2008. So I have a lot of information when it comes to finance. So we're going to jump right into the cash versus accrual accounting. Accrual accounting, under this method, revenue is accounted for when it is earned. Unlike the cash method, the accrual method records revenue when a product or service is delivered to the customer with the expectations that the money will be paid in the future. In other words, money is accounted for before it's received. Likewise, expenses for goods and services are recorded before any cash is paid out for them. When it comes to cash-based accounting, under this method, revenue is reported on the income statement only when cash is received. Expenses are recorded only when cash is paid out. The cash method is typically used by small businesses and for personal finances. So just a side note, cash-based accounting is not accepted by GAAP, not accepted by the IRS, not accepted by banks. So using a cash-based accounting may be easy. Like as a business owner, you could probably do it yourself, but that's not the purpose of this video. So what I'm saying is, for better management purposes, for better financial leverage, for better, if you wanted to go into the bank and get a line of credit, or if you wanted to go to the bank and get a small SBA loan, you will need to hand them some financial statements that's done on the accrual basis of accounting, right? GAAP, according to GAAP, generally accepted accounting principles, according to GAAP. Let's say if you needed to get an audit done because you wanted to have like some private equity firms invest into you, right? Invest in your company. You would have these financial statements, which are the balance sheet, income statement, and statement of cash flow, handed to the auditor company. The audit company would audit it just to make sure you don't have any fraudulent transactions, to make sure it's reasonably clean and free of errors. And then after you got a good opinion on your income statements, then you hand it to the private investment firm, right? Equity firm. And then they'll have the mind, they'll have what is it called? The decent, I can't even think of what it's called, the mindset, the reinsurance to go ahead to invest into your company. So that's the difference between the two, and I'll tell you that's my difference between the two. And then also you can make better management decisions, and that's what this key difference says down here. And I'm just going to read it to you. The key difference: accrual method. The accrual method records accounts receivables and payables, and as a result can provide a more accurate picture of profitability for a company. Everybody want to know if their companies are making money or losing money. You just don't want to be spinning your wheels just for nothing, particularly in the long term. So we want to make sure your company is financially fit and you're not just burning through cash for no particular reason. So that's what the difference is. So we offer services in accrual accounting, services that could get you to close your books on a month-end basis or a quarterly basis, or you could even go biannually, means twice a year, every 6 months you'll close. But either or, it'll get you there, and it'll make sure you have those financial statements for tax filing purposes at the end of the year. So that's what you need. You don't want to wait until the end of the year to do your accounting, because accountants will know that and they'll charge you more, right? Because that'd be more, it's a faster delivery time. You're rushing them through something. You should have kind of done it throughout the whole year. So you're asking them to pull off like a Hail Mary at the end of the fourth quarter, right? And you didn't do nothing all game long. You don't want to be in that position. Just do your books all year long. Keep them real clean. Allow for the accountants to do adjustments throughout the year. When it comes to filing your taxes, just a press of the button to print out those financial statements and get it to your tax accountant. We also do tax services too. So it's that simple. You want to stay not financially, but you want to stay financially healthy, I guess, with your books, right? You don't want it to be all over the place. You want to be flexible and be able to be able to produce those financial statements at the drop of a dime. So these are other principles in accounting that your accountant should be talking to you about. You should have heard these words before in the past. If you haven't, you might not have the right guy doing your books. So you should definitely hear this. The matching principle. That's this one right here. So that's back to the accrual accounting, where it try to matches the earned expenses. Like if you had like a lawnmower cutting service and you paid for labor and you paid for gas and you paid for travel time or something like that, you accrued those expenses, and then you need to match the revenue with that. So what accrual-based accounting does is it matches the revenue, whether you receive the money or not, with that expense, right? So that's what it's called, the matching principle. So now when you print out those financial statements and you're looking at the profit and loss statement, the P&L, the income statement for that month, it shows the real story. So you just don't have all these expenses with no offset revenue, right? So you got revenue, and then you got minus expenses, and then you got net income or earned income, which you're taxed off of. But that tells you whether you're profitable or not. And it could tell you like, oh, maybe I need to raise the cost of the price, or the price, right? Not the cost. Maybe I need to raise the price of the sale so I could squeeze out more money. Or maybe I need to look for cheaper labor or cheaper gas. You know what I mean? Because we're coming in too high. So those tools are used for management. Tools are to manage the business and help them stay profitable and healthy, right? And then we have other things like revenue recognition principle. which we just kind of discussed when we said you want to accrue those revenues. Even though you have not received a check yet for those services, you still want to get it to match the expenses, right? So the revenue recognition, it's more to it than that, but you have to know when to recognize revenue and what revenues are okay to recognize. You don't want to inflate your income statement. If you inflate your revenue, ultimately you inflate or overstate the income at the bottom line. If you overstate the income at the bottom line, you're going to be charged more for taxes, and you don't want to pay more taxes. You want to pay less, right? Or you just want to pay what's fair. You don't want to get overcharged. Full disclosure. This full disclosure principle, this means like you want to make footnotes at the end of your financial statements, kind of telling them about things that hasn't happened, that may happen, because you don't want your investors, the whole thing about accounting services is that you don't want to commit fraud in any kind of way. Like knowing that you may be sued for $1 million and possibly lose your company, but you're still out there, trying to not drum up business, but trying to get investors to invest in your company, and you hiding this big charge that you might be faced with. Basically, you're trying to get them to invest in your company so you can pay that off. That's fraudulent. So you don't want to hide anything. You want to footnote that into the, it's called footnotes to the financial statements, right? So you want to have that in there. We talked about accrual principles, what you can accrue. Time period principles, principle of periodicity. We talked about that in the 12 months, right? You want to cut the months up or cut the year up in 12-month increments, and then you want to classify things based on transaction date, right? So let your expenses lead when you book your revenue. So things of that nature that they need to be talking to you about. The principle of materiality. You don't want to go searching for $5. Materiality states that what's material is anything that's more than 5% of your total assets on your balance sheet. Anything less than that, the auditors don't care about it. They're not going to look into it. So it's no need for you to spend all your time chasing down things that's less than 5% of your total assets. They're not going to look for that. It's immaterial, right? So those are the type of things that you want to look at, and you want your accountant to be talking to you about, like this one, the monetary unit principle. That states that you should only represent your your financial statements in one monetary unit, meaning you shouldn't have euros and dollars and Australian dollars all mixed in your financial statements, hoping that somebody else is going to translate them for you. No. You do what you call a currency translation, FX, foreign currency translation. That's something, this is if you're doing business with people overseas or something like that. You have to make those elimination entries and translate the currency. And then you take the gain or loss to the income statement at the bottom. Recognize gain or recognize a loss, depending on the translation. So these are things that you need to be aware of. All right, going on to the next slide. So now we're going to take a look at the 10-day business close, right? So these are 10 business days. And this is the accounting, this is accrual accounting process, the month-end close process. This is what you should be hearing from your accountant, right? On the first day of the current month. Let's say it's January 31st. Close out accounts receivable and post all revenue for the month. January 31st, hard close. We're closing the books for January. So at the end, at 5 o'clock, January 31st, this stuff should be closed out and booked. And it's easy to do because revenue usually comes in, it happens as it happens in real time. So you shouldn't really be behind on receiving or booking revenue, right? As soon as you know about it, you book it. If it goes to the next day, well, you didn't make the sale February 1st. That goes into February 1st if you know about the sale on February 1st. If you know about it January 31st and before, that goes into January. That's kind of how it works. So that's the first day. We call that day 0. Day 1 is actually the next day, which is February. So then you got 2 days to kind of reconcile the bank statement or the bank account. And this should be done in Excel and in your software. For example, we use QuickBooks Pro Advisor. So we'll reconcile it in QuickBooks and then we'll reconcile it in Excel. And the reason why you do this is because Excel is more of a canvas that leaves like, you could get creative and it's more flexible. It's not stuck in the system. But at the end of the day, both of these should balance back to each other, right? So as long as they agree, you always want to have like, these are called like double or checks and balances. As long as the system agree with the reconciliation that's done in Excel, we're fine. All right, so that should happen, day 1 and day 2. By the 5th business day, right? Accounts payable needs to be closed and all expenses should be posted. So what that means is, those little straggling invoices that are expenses that relate to January, and it clearly says the service date is in January. It says it there. Like you can see some receipts like, this particular employee bought gasoline and he turned in a receipt or a credit card with a transaction date of January 28th. So we know that's January. Or you get a credit card statement, they close off the credit card statement January 31st. It probably take 2 days to mail it to you. So, but you look for all those transactions that happen in January and you make sure those are posted. And then you accrue for the rest, meaning you hold them off and you book those in February. Not accrue for them, you just book them in February. So you was kind of, if some crossed over, right? So you just book those in February. So once that's done, at that point, so now that the bank recs is done, that should be all the cash coming in, cash going out. And then you want to start doing the reclasses and accruals and adjusting entries. So, you want to roll the numbers forward on prepaid expenses. You want to roll the numbers forward on fixed assets. So they'll hit the income statement, the P&L. You want to roll the numbers forward on accrued expenses. So this is like just booking all the missing, bills that you don't have. The bills that you don't have, like for example, if you have an audit you have to pay for, you just want to make sure you expense 1/12, meaning the January portion of that bill right there, and that portion would hit the expense. Or if you have, let's say, insurance that's due annually, but you just want to expense 1/12 of that, you make sure that hits the P&L. So those are the accruals and adjustments that you would make. Also, number 5, by the 9th day, you should start researching the different variances, because now you have like the preliminary financial statements, and then you should start researching the variance between the budget, which you did before, you know what the budget is, against the actual, right? So for example, if we budget $100 for, I don't know, cable, right? And it's nothing there for cable, that means we didn't receive the bill. Where's the cable bill? We know the cable worked, and we see it right there. It's still working. So we'll just go ahead and accrue for that $100. Or if it's bigger variances, we might have to do a little bit more research. We couldn't just go ahead and accrue. for it. So we'll look at forecasted revenue. We'll look at budgeted expenses as well, and we'll accrue anything that's large or small. We're not too much worried about the small ones. We can always catch that later, but especially the big fall offs, because we want to get our financial statements as close to budget as possible, because we're saying the budget is most likely correct, right? And we're most likely wrong, or not wrong, but we just missed something. And we got to see why. If we can't explain why we don't have that cable bill, like a good example of why is we turned off the cable because we didn't need it, and we end up paying it through credit card or something like that. And we prorated it, and we only paid for the first 2 days of it, and we didn't really need it, so it's a small charge. And that note is going to stay there throughout the whole year. It's never coming back. We would have to adjust. At that point, we want to go adjust the budget down for that particular line item and say, hey, this is 0. This should be 0 for the year, and it's going to stay that way. All right. So that's that. And then on the 10th day of close, the financial statements should be ran and distributed and reviewed and then signed off by the executives and the different departments, right? They don't have the department heads, they don't really have to see the entire financial statements. They could, they don't have to, but maybe they want to see just their portion and see, you know, what the actual numbers are versus what the budget say they should be at, because you want to make sure they don't go over budget, because if all these departments start going over budget, and then you're going to be over budget and you're not going to meet your mark at the end of the year, and then you're going to be inefficient, and you don't want that. So, and then after they review that, they sign off on it. The CEO signs off of it, the CFO signs off on it, and then we have a hard close in the books, and these numbers are forever locked in time, frozen. They should not move. I'll go in and I'll close out QuickBooks. No more entries to January 2024. Don't touch that. Put a protected password on there, and it's no going back. Any type of adjustments or mistakes that we see in there, we'll make it in the current period, which is February. So that's how it works. And then after that, that'll bring us to like the 10th business day, and that'll bring us to the middle of the month, which is probably around February 15th, right? So when we're at February 15th, what we want to do then is start working on our balance sheet reconciliations. So when you do balance sheet reconciliations, this is you printing out the account information, like the debits and credits that went into the different accounts, and then reconcile the GL, the general ledger, reconcile the general ledger for whatever specific account versus what it is in Excel. So we do a roll forward report in Excel, roll those numbers forward, and then add any ins and outs that we may have missed that's in there, and then we reconcile it. So we want to leave natural balances. So a natural balance is like, I don't know, like something like inventory. Inventory is an asset. The natural account balance is an asset balance, which is a debit. So that should only be in Excel. You should only see debits, right? And it should tell you exactly what that item is, and it tells you exactly what's in inventory. Like for example, if you're a school per se or something like that, and you hand out laptops and books, it should be like, we got 10 books, we got 12 laptops, and that totals, I don't know, you know, $5,000 or something like that, right? And that's what it should look like. And that's what it should say on your financial statements. And that's what it should say in your actual general ledger inside of QuickBooks or whatever system that you use. And that's pretty much it. And that's how you have a clean accounting books for quarter close. You want that. That's where the banks look into when they're about to loan you money, the quarters. For a year-end close, the audit, usually if you need an audit, all companies don't have to be audited privately held companies don't need an audit. You usually would want to audit. One, if you have a big company, you just want to make sure nothing happens. So that's a second set of eyes. It's a checks and balance to make sure your accounting department is doing the correct thing and your CFO is on the up and up doing the correct thing. Or you could get an audit, usually when people want to invest into your company, if you have some investors, then it's worth getting the audit as well to give your auditors, or not the auditors, the investors a peace of mind to invest in your company safely. So that's that. So if anybody is in need of all this type of services and stuff, I'm a certified QuickBooks Pro Advisor expert. QuickBooks has come a long way, but I have more experience that, like, if you have a bigger system, let's say an ERP system, let's say like Hyperion, Lawson, SAP Business One, I don't know, Sage, Abila. These are just some of the few softwares that I know of that I have experience in. Let's say, for example, if you had SAP, we said SAP Business One already, MAS 90, MAS 200, MAS 500. I also have experience in that. A whole host of industries, from manufacturing to healthcare to entertainment industry to the food industry to, I think I said entertainment already, to e-commerce and to the nonprofit world. So I have all types of, so it doesn't have to be QuickBooks. You just have to give me access to your software, and me and my staff could get to work and help you produce those financial statements. So here's a link, number 2. There's a link to my Pro Advisor if you just wanted to check out some of my services that I provide. Here's another link to my Upwork profile if you wanted to go through Upwork and request some of my services. There's a link there. If you just wanted to email me straight direct, here's my email address. It's dlampkin@lampkincorporation.com. 5, here's my phone number, 562-244-2216. If you wanted to call me and have like a 30-minute consultation to see what you need and to get pricing. Like I said, we give a 30-minute consultation. And then here's my website, www.lampkincorporation.com. You could go there and check out some, it's really a full, we provide business consulting services. So not only do we do accounting, which this video is about, but we do finance, and we also do marketing. So we can help you any kind of way in whatever area you need. You just have to reach out. So you guys could screenshot this, or you could send me an email or call me up, and we could get started right away. So here's my Pro Advisor. My name is Antoine DeMarco Lampkin. I go by DeMarco. So if you hear somebody say DeMarco, that's me answering. Here's my what is this? This is my Upwork. I think you can see my resume on there if you wanted to. That's my Upwork profile. So thank you guys. Enjoy the rest of your week, and God bless.